Silver isn't being ignored, it's being held down. And the people doing it may be the same ones quietly buying every dip. There's a growing argument making its way through the precious metals world that sounds crazy at first, until you connect the dots. Andy Schectman is saying silver could see an extreme multi-year move higher. Not 2 times, not 5, but something closer to 50 times. Not because of hype, not because of memes, but because the system underneath silver may already be breaking. In this video, we're going to walk through exactly how this theory works, why the price action looks so fake, who's actually buying, and why most investors might not realize what's happening until it's too late. Schectman's entire thesis starts with something very simple. There isn't enough physical silver. Not, it might get tight one day. Not supply could struggle if demand grows. He says we're already in a structural shortage right now. Here's what that means in plain English. Every year, silver comes from 2 main places: mining and recycling old silver. That total supply is supposed to cover industrial use, investment demand, jewelry, coins and bars. According to Schectman, for several years now, that math hasn't worked. Demand has been greater than supply, not once, but year after year. And instead of prices exploding like you'd expect, silver just goes sideways, or drops, which raises a simple question. If silver is so plentiful, why does the market keep needing paper contracts to fill the gap? Schectman keeps pointing to this window, 2025 into 2026, as a pressure point. Why? Because multiple long-term trends are starting to collide at the same time. Massive government debt, a weakening U.S. dollar, countries settling trade outside the dollar, central banks buying real assets again, and industrial demand for silver hitting new highs. This isn't a one-headline story. It's more like watching cracks form in a dam. For decades, the world ran on one simple rule: dollars, bonds, and trust in paper promises. That trust is fading, and when trust fades, money looks for something solid. One of the more uncomfortable parts of Schectman's argument is who is prepared and who isn't. According to him, Western retail investors are under-allocated to precious metals. Pension funds barely hold any gold. Silver is almost an afterthought. At the same time, foreign central banks are buying metals steadily. Sovereign wealth funds are increasing exposure. Large institutions are accumulating on weakness. This isn't loud. There are no fireworks. It's quiet. And quiet accumulation usually happens before price discovery, not after. Now, this is where things get controversial. Schectman describes a repeating pattern that looks like this. During the thinnest trading hours, massive futures orders hit the market. Prices fall fast. Stops get triggered. Algorithms pile on. Headlines scream silver top or gold crash. Retail gets shaken out. Then something strange happens. Large U.S. banks step in and buy immediate delivery contracts. Not paper to flip, not leverage trades, physical claims. He specifically names Morgan Stanley, Bank of America. The accusation isn't that markets move, markets always move. The accusation is intent. Dump paper to break price. Buy physical at the discount. Repeat. If that sounds unfair, that's kind of the point. Here's something most people don't realize. The silver price you see on a screen, that's a paper price. It's based on futures contracts, not bars moving from one vault to another. Schectman's claim is that there are far more paper claims than physical silver. The system only works as long as people don't ask for delivery. The moment too many do, the illusion breaks. That's why he constantly emphasizes physical ownership, not ETFs with layers of promises. Not derivatives, not trust us structures, actual metal. This is where his argument starts lining up with what big banks are saying publicly. Morgan Stanley's CIO has talked openly about a 60-20-20 model. 60% stocks, 20% bonds, 20% gold. That alone is a massive shift away from the old 60-40 playbook. Then you have Bank of America strategist Michael Hartnett floating something even more radical. 25% stocks, 25% bonds, 25% T-bills, 25% gold. Gold treated like a core asset, not a hedge. Here's the key detail. Even with all this talk, actual gold allocations remain tiny for most funds. That means if institutions move even a little closer to what they're publicly suggesting, demand explodes. And silver, historically, doesn't stay quiet when gold moves. Schectman also ties silver into something bigger than money. Silver isn't just shiny metal. It's everywhere. Solar panels, electric vehicles, electronics, defense systems, medical equipment. Governments now openly talk about critical minerals and supply security. Recent legislation in the U.S. focuses on securing materials that are vital to economic stability, national security, energy infrastructure. Silver fits right into that conversation, whether it's officially named or not. And once something becomes strategic, it stops being treated like a cheap commodity. Another pillar of the 50 times thesis is de-dollarization. Countries are slowly doing things that used to be unthinkable. Settling trade in local currencies, using gold as neutral collateral, reducing dollar reserves, talking openly about commodity-linked systems. BRICS nations get mentioned a lot here, not because they're perfect, but because they're experimenting. When money systems change, metals reprice violently. History shows that over and over. Schectman is very clear about this. 50 times is not a forecast. It's not a price target. It's not a timeline. It's a thought experiment. What happens if silver has been suppressed for decades? Physical shortages persist. Monetary trust breaks. Investment demand rushes in, and paper claims fail at the worst possible time. In disorderly resets, prices don't move politely. They gap. Why the volatility is the point. If silver were truly weak, it wouldn't need to be smashed so often. Wild downside days and thin liquidity aren't signs of health. They're signs of stress. Schectman's view is that volatility is part of the accumulation phase. Price drops are used to scare weak hands. Strong hands don't chase, they wait. That flips the usual narrative upside down. What this means for investors. This isn't about day trading. Schectman's framework is macro and long-term. The implied takeaways are: think in years, not weeks. Favor physical or fully allocated exposure. Treat sharp sell-offs with skepticism. Watch what institutions do, not what headlines say. Most importantly, understand that silver isn't just an asset. It's a pressure valve in a system carrying too much debt and too many promises. The real risk nobody mentions. The biggest risk isn't silver going to zero. The real risk is being positioned for a world that no longer exists. A world where debt always rolls over. Paper claims are trusted. Central banks don't need real assets. And scarcity doesn't matter. Schectman's argument is that world is ending. Slowly. Then suddenly, conclusion. Silver's story isn't about hype or quick gains. It's about structure, trust, and math that no longer balances. If even part of this thesis is right, the quiet years we're in now may be remembered as the calm before a very loud repricing. Whether 50 times happens or not almost misses the point. The real question is whether silver is being valued for what it is, or for what the system needs it to be.